So good afternoon, everybody, and welcome to the last session of the day. Many thanks to Warren and Haley for this great conference and for inviting us to this panel. I am Bettina von Hagen. I'm CEO of EFM, a Forestland investment and advisory firm based in Portland, Oregon. And my colleague Amrita, who will be speaking in this panel, would describe EFM in more detail. And I am your moderator for the day. This panel is going to explore the state of carbon and other ecosystem service markets in North America and the potential to invest in forest land and other natural landscapes in the US to advance carbon sequestration within an investment context. Until now, forest land investing is a very mature class, and forests are definitely large storers of carbon, but we are talking about something different here. We're talking about the potential of forest land and forestry investing to be net sequestration of carbon, to actually be reducing emissions from the environment. And this panel is dedicated to really illustrating those strategies and the markets and ecosystem services that support that. With the advent of carbon and conservation markets, you have innovative forest land managers, and we have two of the most innovative, experienced, and successful here in the form of the Forestland Group and EFM, who are managing forests holistically to not only produce timber and have all the great attributes of forest land investing, but also to manage for carbon and for biodiversity and for water and for a whole array of public services that benefit not only investors, but also the public and landscapes. And so this panel will explore these forest land investment strategies in more depth, and then also explore the ecosystem markets, particularly carbon, that support that, and the public strategies and philanthropic investments that further support these strategies and advance them. Our panelists include the leaders and experts in the field. First, we will lead off with Blake Stansell, who is the CEO of the Forestland Group, which manages natural forests to deliver financial returns, climate mitigation, and ecological impact, with a focus on eastern US hardwood forests. Blake will be followed by Amrita Vatsal, Managing Director of EFM, who will describe EFM's climate forward investment strategy, which is focused on the carbon-rich forests of the West, and a strategy that involves not only producing high quality timber, but also sequestering carbon, protecting biodiversity, protecting water resources, and very importantly, which is important to the Forestland Group as well, enabling economic development in rural communities and for forest workers. Amrita will then be followed by Curan Bonham, who is the incoming program officer at the Rk Melon Foundation. The Mellon Foundation has a very long history in forest conservation and in facilitating forest conservation. And Curan is very experienced from his prior position leading Conservation International Ventures. And Curan will discuss how philanthropic capital can accelerate the transition to climate smart forestry and what foundations can do in addition to private capital to achieve these goals that we want around forestry. Curan will be followed by Stephen Donofrio, who is the manager of Ecosystem Marketplace, which is an initiative of forest trends and the leading source of news on carbon and ecosystem markets. And he will report on the current state and existing and exciting new developments in carbon markets. Ecosystem Marketplace, for any of you that spend any time on carbon and ecosystem services, I'm sure it's your go-to resource. And it has a really unique position in the industry as a non-aligned, transparent source of the most diverse and comprehensive data on carbon and other ecosystem service markets. Finally, David Antonioli, who doesn't need an introduction to any of you engaged in carbon markets, is the president of Verra, the world's leading standard-setting program for certification of greenhouse gas emission reduction systems. He will describe exciting policy developments, including the work of the Task Force on Scaling Voluntary Carbon Markets, also known as the Carney Report, and the bipartisan proposed legislation on carbon markets, the Growing Climate Solutions Act. In terms of the panel format, each panelist will introduce themselves, their company, their initiative, and their contribution to this topic for about 3 to 5 minutes. And this will be followed by a discussion among the panelists. And finally, we will open it up to questions from the audience. And with that, Blake, please take the stage.
Thank you, Bettina. Really looking forward to the conversation and appreciate the opportunity to be a part of it. My name's Blake Stansell, and I'm the president and CEO of the Forestland Group. We're a traditional timberland investment management organization in the context of managing institutional capital for investment in timberland. But more specifically, we're a sustainable natural forest manager delivering large-scale climate impact along with investor value. We're located in the eastern United States in the state of North Carolina. The company was founded in the mid-90s, and we were organized based on this theory that by working with Mother Nature in natural forest systems, the ecological characteristics of native forests could serve as an engine to produce steady cash flows and long-term returns, perhaps with less volatility than some of the monoculture type strategies that were mainstream at the time. We've been able to kind of stick to our roots, and we're excited about that in terms of what our founders established for us. We just celebrated our 25th anniversary in the middle of the pandemic last year. I think we made the most of it. I personally have had the great privilege of being with the company for almost 21 years, and it's been an absolutely fascinating journey. We've invested about $2.6 billion US in 4.5 million acres of timberland, located in 24 different US states in the eastern part of the US and 4 other countries: Canada, Belize, Panama, Costa Rica. The current portfolio is about 2.3 million acres, so just under a million hectares. We invest primarily through commingled funds, and we currently have 8 different fund portfolios that are in various stages of management and tenure. In terms of our environmental impact over our 25-year history, we're very proud to have protected about 1 million acres through permanent protection, conservation easements, or through transactions with NGOs and public entities. We've been certified sustainable in our forest management for over 15 years. And then on the carbon side, we have developed 17 projects. Actually, I think it might be 18 with a more recent project we're working on in Canada, but 17 or 18 projects covering more than 1 million acres. And we continue to pursue new opportunities to expand our carbon program, both in the voluntary and in the regulatory market. The common thread that really holds all these activities together is the focus on natural forest management and on creating value, both economic and ecological value. And hopefully we'll be able to talk more about this later on, but the natural forest landscapes that we manage deliver significant carbon outcomes with co-benefits. You heard a lot about water in some of the previous panels, and I think there's additional co-benefits to talk about. And then also the forests are very resilient in terms of age class and species structure. So I look forward to talking through some of that. We believe that by implementing climate smart practices, we have the opportunity to improve the overall health and vigor of the forest and deliver both climate impacts and investor value. And I think it's especially exciting right now, given the dynamics of the North American marketplace. For the first time in at least a decade, maybe 2 decades, the outlook for timber pricing is very bullish. There's a lot to unpack in that statement, and I know I'm running out of time, but lumber prices are going crazy right now. Standing timber prices haven't changed that much, but certainly the outlook is bullish. And then at the same time, we have these evolving and improving markets for ecosystem services, especially carbon. So I think there's a unique opportunity, a growing opportunity to provide natural climate solutions at scale by keeping natural forests intact and healthy through sustainable management. And that's where we at the Forestland Group are focusing our efforts. So look forward to the rest of the discussion, and I'll pass it over to Amrita.
Thank you, Blake. It's so great to hear about your strategy and observe the similarities in the threads of our work. So looking forward to exploring that. Good morning, everybody, or good afternoon. I'm Amrita Vatsal, Managing Director with EFM. We have been investing in nature's best climate solutions since 2005. And in the US, that we've been implementing an approach to climate smart or carbon forward forestry within an institutional context on over about 120,000 acres across 4 Western states. More recently in Latin America, we've also begun working with private investors to structure climate hedging investment strategies that produce carbon removals for an investment portfolio. And we're really excited to finally be here in this position today, where we feel like the wind is finally at our backs. In the US, we have seen a really significant shift in the institutional investment landscape for timberland over the last decade, where there's really been an increasing acceptance for forestland strategies that integrate non-timber approaches, especially in the face of, perhaps an eroding return environment for the asset class in what has been a very mature industry. In fact, we've noted studies as well by the likes of Cambridge Associates and GIN that have shown that impact investment strategies like EFMs and the Forestland groups to really tend to outperform traditional strategies, and sometimes by over 2%, as their studies noted. In the western part of the United States, where we primarily operate, a large part of that success has really been driven by strategies that have accessed the compliance carbon markets in California. And in the East Coast, it's been driven to a larger extent, though not exclusively, by the access to federal and state conservation funding. At EFM, our forestland strategy is really targeted around building portfolios that are diverse, that target diversity in revenues, capable of accessing multiple sources of easement funding across federal and state agencies, tax credit programs, integrating carbon offset market strategies. Primarily, we're focused on the voluntary markets, and we can get into that further, mitigation banking programs, etc. And so in the process, what we're trying to do is to restore industrially managed forest lands using FSC certified strategies while protecting drinking water, preserving habitat, and fireproofing landscapes. So, we talked about this as the future of forestland investing in North America. I think that this is just the beginning of a paradigm shift for investors in forestland. Studies are now showing that over 22% of the carbon mitigation potential from natural climate solutions in the US needs to come from natural forests. So strategies like ours will really have to be at the forefront of climate solutions. And we think that the Western US, especially the coastal forests, is the place to be implementing a carbon forward strategy because of this wonderful optionality between timber and carbon markets. This region is the center of global softwood conifer production. It's got great domestic markets and access to infrastructure. And the species here put on more carbon per acre than any forest type in the world. And given that these are native species, they're also capable of growing well past 100 years. And so it's that durability of emissions reductions and the permanence that makes forests in the West a very attractive quality. And so with that, I want to maybe just close by saying that, this is, from our perspective, a really interesting time to be investing in forestland. Blake noted the emerging markets and environmental services. I also think that there's a real opportunity for differentiation and increasing value to come from the green building and the wood products, innovation in the wood product sector. So I'd be looking forward to unpack all of those themes with you during our conversation as well. So over to you, Curan.
Great. Thank you, Amrita. Very interesting work. I look forward to hearing more about it and learning more. So I'd also like to say thanks to Bettina for moderating the session, and Warren for organizing this entire workshop. And I really to everyone on the call for spending your time with us today. So Bettina gave a short introduction of who I am. I'm the program officer for the Rk Melon Foundation. But what she didn't mention was that I'm actually a forester as well, having cut my teeth on cruising timber in the Intermountain West, Ponderosa and Douglas fir forests out there. But also having some experience in South America, working in Chile on the eucalyptus and radiata pine forest down there. So it's a great pleasure to be with you all today. So let me tell you a little bit about the Rk Melon Foundation first. We were founded in 1947, and it's the largest foundation in southwestern Pennsylvania. So I'm calling today from Pittsburgh, Pennsylvania. And the foundation is actually one of the largest in the world, among the top 50. Our endowment is something on the order of about $3 billion US. And in 2020, we granted over $130 million. Our chief strategic priorities are in economic development, in economic mobility, in health and well-being, and of course, conservation. And we carry out that mission across all 50 US states and territories, with a particular focus in southwestern Pennsylvania. So with my colleague, Brian Hill, we manage a portfolio of conservation investments that is on the order of about $40 million annually. And over the past 35 or so years, I would say we've been able to protect and convey into long-term conservation over 4.5 million acres across those 50 states. So quite an accomplishment that probably many people aren't aware of. In the last, I would say 15 of those 35 years, we've invested about upwards of $20 million into a program that really focuses on working forests. And we use low interest loans, or what we call program related investments, or PRIs, to do that. Essentially, that funding is used to purchase large blocks of farms, estates, ranches, timberlands, which are then over time placed under conservation easement, which is a unique legal encumbrance here in the United States. At which point those lands are then conveyed to a long-term land management partner, essentially achieving and limiting development rights in perpetuity, but also maintaining those key values that allow for productive management of those lands. And that includes timber harvests and recreation, among others. So this model has been extremely effective in kind of stemming this massive and kind of still ongoing divestment or disinvestment of long-term forest land managers, which really kind of threatens to fragment these large forest blocks. And so really over the last 10 to 15 years, we've been able to work with our close partners, the Conservation Fund, to conserve over 600,000 acres through this model, which we have been, developing kind of financial support around, and currently manage a fund about $150 million towards this purpose. And I just would kind of close by saying one last thing, in terms of just giving you a little bit of an example of kind of how we work, and particularly kind of more recently, we've worked in Georgia to acquire a 5,000 acre tract of forest, which we will then put conservation easements on and convey to the state, that will then become a part of an existing state piece of state lands in Georgia. So you can kind of see how that model works. It's been so successful, in fact, that this model through the Conservation Fund released, or I should say, created a green bond with Goldman Sachs in 2019. And this $150 million green bond was oversubscribed in short order. But it goes to show that this model really has legs and commercial applications. Of course, we began this entire endeavor through purely grant capital and have now graduated some of our partners to now using this revolving fund that we currently manage. So I'll leave my my initial kind of comments there, and I believe I'll kick it over to who's next on the list, Bettina? I think Stephen is Stephen next.
Stephen is next. Yes.
Okay. Thank you.
Thanks very much. Yeah, great to be here today, and equal thanks that other speakers have offered to the organizers, Warren and Bettina and everybody else, and fellow panelists and people here today to listen in. So I'm Stephen Donofrio. I'm the director of Ecosystem Marketplace, which is an initiative of the nonprofit organization Forest Trends based in Washington, D.C. I'll be really brief in terms of the overview of who we are, but I want to try to get into some of the kind of the details and what I think Bettina thought of as a reason to bring us, together here today, and particularly thinking about investments and opportunities for carbon offsets in the forestry landscape here in North America. So our work fundamentally has been over the past 15 years to track, opaque environmental markets that traditionally do not have a centralized trading system or mechanism or platform where that information would be recorded and put together into one place, so that typical commodity or compliance, voluntary, commodity markets or compliance carbon markets, you would see this type of information exist and be able to, be pulled from and used as reference information. So our work has been to survey the global market. Last year we had a significant sort of increase in number of respondents. We had organizations from around the world reporting data to us, covering market transactions across 73 countries, 20 different standards, of which Verra VCS was the prominent one in terms of market activity. That data that reported came in through 41 different project types and 21 different buyer sectors. So a lot of diversity of information that gets recorded by the process that we go through of surveying the market through direct engagement by what has traditionally been an annual cycle, which we are now strategically and very fundamentally changing for 2021 and going forward, as a number of different factors, which I'll highlight, are taking place that's driving the market in a much more significant way than I think we've seen in years past or really ever before. And so what that means for us is moving from an annual cycle to a more regular cycle to provide data on a more frequent basis about pricing, volumes, interest in different project types and standards and other types of criteria related to the voluntary market. So this is a very diverse, disaggregated market that there are ambitions right now, and maybe I'll let David get into some more of the details on initiatives such as the Task Force on Scaling Voluntary Carbon Markets, of which David has a role in, and we have a role in as well. But it is a diverse group of traditional or sort of long-standing market actors, as well as a lot of new market actors from maybe traditional commodity markets, or that are coming in from maybe other types of investment into sustainability, and now looking at offsets as another pathway, for decarbonization, as well as investment into climate solutions. And so with this mixture now of different type of actors, we're just seeing a whole lot of new activities related to trying to help these thousands or so of companies that are jumping on board to establish net zero goals, so that they can understand how to clearly articulate those net zero goals that are decades long in terms of their time horizon, and where offsets, should and very well could fit in sort of the kind of the near term or the phase term, as various different sort of guidance approaches that are out there are trying to help companies, in that pathway. And that also then means, what is the guidance for investors and other types of institutions that are looking at this investment space and trying to understand, quality of credits or quality of standards, quality of project types, or the whole mixed bag of information that relates to ensuring the success of this market, and also the success of us meeting climate goals, which we really need to be kind of aware of the fact that, in order to meet Paris Agreement ambition of getting to 1.5 degrees Celsius, we need a significant amount of investment to be made in not just reducing emissions, but investing in nature-based solutions, whether that's more sustainable land use, but also, forestry and other types of land use projects from an offsets perspective. And so I'll just sort of leave with a few kind of notes here, which is that, transparency in any market is really what will drive confidence and drive, investment. The demand side is yearning for this, and we're getting increasing requests for the data that we collect in order to help inform their pricing estimations about how a forestry project in North America, which when we ran our survey last year, we found that forestry and land use, reforestation, sustainable forest management prices were, around $7.50 a ton for an offset versus, some, renewable energy credits from, India or China, which were priced at below $1 a ton on average. So there's a really big diversity in terms of the appetite for project types, as well as the pricing that different project types will get, and so much of that it has to do with kind of the additional benefits that are found in nature-based type of projects, going beyond carbon and into other biodiversity or other ecosystem services, whether it's around watershed protection or other social, benefits that might have to do with protecting local communities or working with indigenous and traditional communities if we're in certain geographies. And so that factors into the pricing here, but it also factors into the end story of why to purchase that type of credit over another type. And so tools such as what Verra has developed around SD Vista to help to quantify sustainable development goals or other sort of sustainability criteria in addition to carbon. Gold Standard, another standard, has developed their own tools to help quantify this, and organizations like smaller plan standards that are maybe more focused on indigenous communities, such as Plan Vivo, have this very much focused for all of their projects. So it's really important to try to understand this market and when developing the approach, because there are many different ways to take it, whether it's purely carbon or it's carbon and all the other benefits that go along with that forestry and land use have to offer. So we're continuing to track this market. We've launched our survey for this year. We are developing, we've sort of evolved into an online survey platform and moving to a more regular sort of on-demand type of reporting system, so that hopefully we can provide pricing updates on a more regular, frequent basis. And we're also developing new data tools and applications to help increase the access to that information. So this is a very exciting time for us, also very busy, very, very excited for this conversation and to be a part of this. Unfortunately, I will have to drop off soon because I have another commitment that's come up, but it's also just illuminating sort of the demand for this type of information by corporates and investors that are seeking forestry as a carbon investment opportunity as well. So thank you, Bettina. I'll leave it there and pass it along to David.
Thank you so much, and sorry you have to go. But I think maybe, Stephen, you could just mention where people can find you if they would like to ask you questions.
Sure. Yeah. I could put it to the chat, my email, but the ecosystemmarketplace.com is the URL for us, and just Donofrio, SDONOFRIO at ecosystemmarketplace.com. Again, I'll put that in the chat, but thank you, Bettina.
Great. Thank you so much, Stephen. And David, please take it away.
Great. Well, thank you very much for the invitation, Bettina, and it's a pleasure to be here with everybody. Yeah, I'm David Antonioli. I'm the CEO and president of Verra, which is an organization that manages a number of standards or greenhouse or programs meant to deliver, climate action and sustainable development benefits. We manage the VCS program, the Verified Carbon Standard, which is the largest greenhouse gas crediting program in the voluntary carbon market. And we certified projects in over 80 countries and across a number of sectors, including natural climate solutions. As Stephen alluded to or mentioned, the market has grown significantly in the last couple of years. And this is based on the interest of a lot of corporates and more recently governments. And we're starting to see that pick up, which is really exciting. And I'll explain what that looks like in a little bit. But the program builds on a solid foundation of 20 years of experience, taking into account, the latest scientific evidence, best practices, and extensive input from stakeholders across the carbon market. And to give you a sense of what we do, we write and update rules and requirements, making sure that projects follow these, that the auditors that are doing the work, are clear, and that making sure that the projects again follow those. And so we write rules. We're a regulator of sorts. If you told me, 30 years ago that I would spend a considerable amount of my time writing rules, I would have told you were crazy, because it sounds dreadfully boring. But in reality, it's quite a unique position to be in, because if we do it right, meaning we make sure that there's environmental integrity and we can drive finance, it can be a very powerful way of driving finance to climate action and for action on the ground. So it's actually kind of a unique opportunity that we have. As I mentioned before, there has been quite a bit of growth in the market in the last couple of years. A lot of that has come from natural climate solutions. Certainly in North America, we've seen a number of projects in the forest sector, everything from improved forest management, like lengthening rotation of harvest, to outright conservation. We're starting to see some interesting projects in the blue carbon sector, so wetlands restoration, seagrass restoration activities. This goes around the world. We're starting to see a lot of really interesting projects in terms of mangroves as well around the world. And then the most kind of recent comer to the game is the agricultural sector. There's been quite a bit of interest in the agricultural sector, but right now we're starting to see some new approaches that are dealing with the challenge with aggregating a number of smallholders, bringing them together. So that's starting to prove to be an interesting source of innovation, but also opportunities for addressing climate change. In terms of the growth in the market, I think there's a few key elements that are driving it. One, of course, has been the dramatic influx of a lot of corporates, and this has led to work of the Task Force for Scaling Voluntary Carbon Markets, which you mentioned, Bettina, which is led by Mark Carney, the head of the Bank of England, and is really working towards a larger, more liquid, and even more transparent market. And the goal is really to address some of the key pain points that people have in entering the market, and creating a globally accepted set of guardrails and governance that will make sure that there's quality and that people understand there's a commonality in terms of what the discussions and what the key criteria that folks are looking at. So I'm pretty hopeful that initiative will be leading to some significant growth if it is able to manage the challenges related to bringing this market that has a number of different rules, but has quite a few of commonalities. And I think the concern is that when people enter the market, that there's a number of different sets of rules, and that's true. But over time, the voluntary market has actually been able to really coalesce around a number of programs, like the VCS program and the Climate Action Reserve and the Gold Standard. And what that means is, hopefully what the task force can do is really tease out the commonalities between these programs and set out what those commonalities are and give people confidence that they can invest in this and really and generate real greenhouse gas impacts and benefits. We're starting to see the inclusion of voluntary market infrastructure, like programs like ours, in government programs or in regulated markets like CORSIA, which is the Carbon Offsetting and Reduction Scheme for International Aviation, that really just said, let's just look at all the infrastructure that's out there and we'll bless or use a number of them that meet our set of criteria. And we've seen this in Colombia and South Africa that have carbon taxes, but have the opportunity or give the people who are liable to pay those carbon taxes the opportunity to pay those carbon taxes in carbon credits. So it's a really unique and interesting policy that is administratively quite simple, because it allows investment in projects directly by those who are covered, and it avoids having to send the money to the government and expect them to deliver that money in some other way. So it's an interesting development. That kind of policy is gaining a lot of traction. And in the US, we recently saw kind of the uptick in interest in the Growing Climate Solutions Act, which is bipartisan legislation, which really would, in many ways, recognize the infrastructure again and the credits issued under existing standards like the VCS and the Climate Action Reserve as a means of driving direct action on climate change. So we're starting to see some interesting uptake in governments. And this, I think, is just important as my concluding comment to say that, obviously we're very excited about the opportunities that the voluntary market can bring, but it's really important to take into account the context in which this happens, or which they should happen, which means that voluntary action in the context of carbon offsets is great, but we need to make sure that people, or certainly the corporates that are purchasing and retiring carbon credits, are taking internal actions first before going to the market. It's really important that corporates really take that message that they need to do as much as they can internally, and that's great if you want to offset your residual emissions, but it's important that they take that step to address their internal emissions first. The other piece, which I think is really critical and gets lost in the noise, is that we, and certainly I, strongly believe that voluntary action is great, but goodwill is not going to solve one of the biggest challenges that we face as a society. And we really do need government regulation and action from A to Z across the board. Now, that means that over time, voluntary action will become limited, because governments will eventually have all of their economies regulated, which will reduce the scope for voluntary action. That's still not happening at scale, and that's going to take 5, 10, 15 years to take place. So in the meantime, voluntary action is critical, and it's a great opportunity to get to drive climate finance and get immediate action on the ground. Thank you very much. Looking forward to the discussion.
David, thank you. And thank you to all the panelists. That was a great, amazing introduction in the time that you had. Curan, thank you very much for adding that example of the state forest in Georgia. That was super helpful to sort of see how these mechanisms work. And I'm wondering if I could ask Blake and Amrita to also provide an example of, from your own portfolios, an example of how you used ecosystem service markets to further a forest land investment, and how that contrasted with perhaps how you would have managed that with just conventional tools where you're depending just on timber markets. And maybe Blake first and then Amrita.
Yeah, thanks, Bettina. Just to maybe tag on to Curan's example, thinking about forest fragmentation, we purchased an asset in the Appalachian region of the eastern United States back in 2004. It was about 140,000 acres, so a nice large industrial timberland property. The timber markets over the subsequent decade after our purchase were less than ideal for generating cash flows and revenue streams. So we had to really start to look at all the available levers that we could pull from a fiduciary standpoint to generate value for our investors. And one of those levers was to start selling property. And we ended up selling about 30,000 acres of that asset even though we would prefer to have been able to hold on to it, there just wasn't an opportunity to do that. But fast forward to 2017, we still had 110,000 acres of that original property, and we recognized an opportunity to develop carbon. And rather than continue to fragment the forest, we were able to lock up the existing stocks of carbon, keep the property intact, and generate some cash flow, and subsequently sold the property to another institutional type investor who continues to manage sustainably on the timber side and have the optionality of generating carbon credits. So it's just an example. I mean, conservation easements would do the same thing, but in this case, we were able to use the carbon markets to keep that forest intact and make the investment viable. Wasn't a home run investment, but it was respectable and allowed us to do what we wanted to and needed to for our investors, but also provided that climate impact through the access to the carbon markets.
Great, thank you. Amrita?
Sure. An example that comes to mind is a recent acquisition of about 25,000 acres in Central Oregon, just about 60 miles south of Bend. A property that lies amidst a really incredible public and recreational landscape with a huge opportunity for ecological uplift and wildlife protection. What was challenging about this property is that, it's a typical sort of east side or dry side property. For those that you're not familiar with the Pacific Northwest region, this is a side, east of the Cascades where growth rates of species are much lower. The value for mixed conifer and pine markets are sort of lower than your very attractive Doug fir, spruce hemlock markets. And so as a result, properties such as these have really not received much institutional interest. And this property that we looked at, like so many others in the region, has been overharvested over multiple decades. And really what is needed today is time for the property to regrow, investment in silviculture. And that really makes it a difficult timber investment proposition. So we looked at this opportunity and chose to sort of implement a different strategy. We added this property to our VCS certified carbon portfolio, which is a group project that we manage. And we launched under Verra's standards back in 2010. This project now encompasses over 27,000 acres in Oregon. And we've chosen really to focus on the voluntary markets for a number of strategic reasons. We developed relationships with Nike and General Motors, who now uses the offsets from this project. And the revenue from the sales allowed us to avoid harvests, to allow the property to rest and regrow its stock. In addition to that, we're accessing federal tax credit programs. We're implementing rotational sheep grazing strategies and creating mule deer habitat, which adds much needed jobs in the region. And as the trees mature on this property, we're planning to tap new markets for biofuels that are also developing in the area. So, this is going to be a restoration strategy that is in the making for over 10 to 20 years. But we think over the long term, this is a great example of how you can use conservation tools alongside traditional markets for timber and biofuels to restore forests and really create investable opportunities for investors.
Thank you, Amrita. That's a really rich example. David, you referenced blue carbon, and it's a subject that fascinates me. I wonder whether you might just mention, I think forest carbon may be more clear to people how that works, but I'm curious about seagrass or mangrove or kelp, how that might work. And I'm just wondering if you could speak a little bit about some of those projects and their maturity and whether they are something that investors should be paying attention to.
Yes, they are. That's very interesting. I mean, I think what's been challenging is the measurement, right? From our perspective, is how do you actually measure the carbon? So there's a lot of new science that's been brought to bear on the ability to generate, robust accounting for the benefits that you're generating through these blue carbon projects, whether it's restoration or in some cases conservation. And so, there's a number of projects. If you go to our registry, you can start to see that in the pipeline of projects, we're starting to see more and more of these. There's the one in Virginia, which is very exciting, which is restoring seagrass. And that's a really kind of interesting project. It's still in the process of being developed. I believe TNC is working on that. And there's a number of others, that are potential. I mean, if you think about what's happening in the US, right, you've got estuaries or, wetlands in areas like the Chesapeake Bay, or if you think along the Gulf Coast, there's got to be probably a number of restoration and potentially even conservation opportunities that I think could be brought to bear. And there's a few existing methodologies. They really haven't been used as much as we expected, but I expect that will change as the market picks up and there's more demand.
Great, thank you so much. Curan, I'm wondering about the philanthropic sector. I know that foundations have been active, both as equity investors and also in providing PRIs, low interest loans, to private entities that are trying to advance climate smart strategies around the country. And I'm curious, you mentioned low interest loans as one of the methods of financing, but I'm curious what else is in your arsenal, or what else you wish could be, or in the arsenal of the foundation community in general, to accelerate natural climate solutions.
Yeah, thanks, Bettina. It's a great question. And, I think that like many investors, we don't want to get, too sophisticated that we get complicated. I think that simplicity works for all of us in terms of getting these types of deals done that are already complicated by their very nature. And, typically, we try to lead with grants. And when we see that an organization has reached a certain stage in their evolution, and they can absorb kind of risk capital, we tend to focus on using those types of instruments because they allow us to be more efficient in the way that we use our capital and to reach more scale, a larger scale. And I just point to one of the unique sides of kind of philanthropy in all of this is kind of that blending of philanthropy and then impact investment. And a kind of a typical question that impact investors have been asking themselves is whether they are impact first versus whether they're finance first. And I think that many impact investors would say they lean towards the impact side, but at the same time they need to see a certain level of maturity in terms of the finance side. Now that level of maturity, I think, varies depending on the types of investors, but it has to be there, and it's important in terms of proving the model and being repaid. From the philanthropic side, there's no question in terms of how we lead from the impact side by law. The powers that be make that clear. So we really need to demonstrate the kind of the philanthropic and charitable purpose of our funding. So that's a really key distinction to be made. And so, I think we're more willing to take risk at an early stage and start with grants, and which is, in the impact investing world, 100% loss, and then slowly ratchet up our support in a way that makes more sense in terms of achieving a kind of a more commercial mission. And of course, using a PRI allows us to invest at a much greater scale than we would otherwise through grants. So that's kind of I would say, our perspective on it. In terms of kind of carbon and other ecosystem service markets, I think that, we see an opportunity for philanthropies to play a role in consolidating in a kind of fragmented and opaque market. So, really being able to support in the activities that are building kind of the enabling conditions around that market. One of those things, and just kind of point to it, since David is on the call, is around standards. We need more standards. The more standards that we have that are verified and legitimate, I think that means the more kind of forestry projects we'll see on the market. So really, I think that's a benefit that has a really clear and tangible public good associated with it, that type of investment. And I think, taking those early stage bets in terms of, I think David mentioned the Chesapeake as well. a target for North American conservation without a question. And many of the kind of efforts there are fragmented, to be honest with you. For those who kind of are familiar with that world, the MS4 requirements or the TMDLs that are allowed, and those are total maximum daily loads, and municipal separate sewage systems. Those are laws that are required by the EPA that municipalities comply with, but up until now really have not. And so that mechanism has really been underutilized in terms of maintaining the quality of the Chesapeake Bay. And so we're seeing opportunities in terms of funding mechanisms that go to replacing riparian buffers on streams that can be pre-financed and then sold to municipalities and others who are liability holders in terms of requirements under those programs. And I think the philanthropic approach is really to look at how we can start to move that, to build the momentum around some of those emerging markets. And I think that's where ultimately we see our role, not only in the kind of stormwater and sewage water quality world, but also in carbon markets.
Great. I'm going to ask you next. Thank you, Curan, to speculate a little bit, and I'm going to start with Amrita, but others can please respond to this as well. So the social cost of carbon from various reports has been seen as $50 to $100 per ton and more, and we are actually seeing that actual cost in some countries, especially some of the Nordic countries. So I am curious, if carbon were currently priced at $50 per ton, how would that influence your strategy, and how for Amrita and Blake in particular, if there's any concern about sort of timber supply, how you would shift from between carbon and timber production. Any comments you can make on that would be very welcome. Amrita, can you start us off?
Yes. Well, firstly, I can't wait for the day when carbon prices are $50 per ton, and I think they're in our future, hopefully sooner than later. But I think your question is a great one. I mean, I think as a forest land owner, you have optionality to choose between whether you want to sell your trees for carbon or you want to sell your trees as lumber to mills. And so, in the Pacific Northwest context, I think a price of $50 per ton is certainly going to drive some potential landowner choices, but I suspect it isn't going to completely eliminate harvesting, and that's because of the value of these logs. I mean, they're extremely high value logs going into high end markets. So I suspect they're going to make certain types of harvesting more marginal. Things on steep slopes with long haul distances. But it's probably going to tip landowners to delay harvests, extend rotations for a longer period of time. And so what that might lead to, I suspect, is potentially a shorter term sort of, or even 5 to 10 year supply disruptions potentially. But I think there's a real opportunity in the West to sort of supplement, the supply from private forests with supply coming from forests that have not traditionally received a lot of investment, like east side, dry side forests that need to be thinned from a fireproofing perspective. The huge challenge we have on our public forests in the West to address fire. I think there's a lot of potential supply that can be increased from other sources to sort of bridge the gap. And I'd say finally, the last comment is probably at that sort of $50 a ton price. We're likely going to see a lot of innovation in the green building and wood product sector, because it's going to make other building products like steel and cement very expensive. And so I think that will drive a lot of innovation in also in the wood product sector, and that might actually lead to more demand in the long term.
Great, that sounds very promising. Blake, how do you think it would play out in your market?
Yeah, I would just add a couple things. First off, on the investment strategy side, it would expand the geography into some areas that are less viable from a carbon perspective because of land values being high. I mean, that's one issue. It's hard to implement a strategy when you have to pay a lot for underlying land. So that would make a difference. In terms of timber supply and $50 carbon, if you think about it on an individual tree basis, it's easy to say, well, climate benefits and timber products are mutually exclusive. You either cut the tree or you sequester carbon. But it's a different thought process at the forest level, right? $50 carbon would certainly change the decision process, but you still need healthy forests, right? You need that engine of growth, which is going to generate the sequestration long term. So, I think there's a balance there, and I think long term you need the forest to remain healthy, and for that you need sustainable management. So I think it's an interesting mix, and I welcome the day when we see $50 carbon for sure.
As do we all. David, do you think it would change your world to see those kind of prices, what you do?
Yes, absolutely. Again, it would be great to see that. I think it would change it in a couple of ways. One, of course, there would be a lot more activity because you'd have many more projects on the market, right? And more people bringing forward projects. I know there's a number of developers out there who are chomping at the bit for higher price, but they're just holding off because the pricing isn't there. But I think that what $50 ton price would also expand the types of projects that are out there. So, people talk about direct air capture, right? It's very, very expensive right now, not even in the range of what current markets might do. And $50 might not be enough to make that kind of stuff happen. But it would start getting closer for sure. It'd be much closer than where we are now. So I think what you'd see is, you'd have a whole scale shifting towards other kinds of project types, which would be very exciting. So it's not all going to reside on forests or on mangroves or whatever. So you'll see a variety, but it's a market, right? But again, that would suggest that there's quite a bit of activity, and it would completely mean we'd have to, have a lot more queries and questions, and of course staffing to address that. We're also kind of already seeing that needing to scale up to the level we are now, and we're just at a fraction of where $50 a ton would get us, which would be great.
Thank you. So we are almost at close. We have just maybe 2 minutes left. And so I think I just want to close by asking each of you, what is top of mind, the most exciting thing that's happening, around climate smart forestry, carbon ecosystem service markets, whether it's a project type or a methodology or a project that you're working on. And we'll close with that, and maybe we'll start with Curan.
Thanks, Bettina. I would say that one of the most exciting kind of developments we've been seeing in this market is kind of the push to engage small forest landowners. So typically, I think what we've been hearing is that only kind of the larger companies that can get to a certain scale can really take advantage of these carbon markets. But we've been seeing it in at least a half a dozen places here in the United States where there are mechanisms and initiatives being developed to really work to find ways to aggregate small landowners into these projects. And I think that is really exciting to us. I think something on the over 50% of the forest land in the United States is privately owned, and much of that is in the hands of family-owned forest lands, and we'd love to see people being able to take advantage of that additional revenue stream. So, and if that revenue stream leads to healthier forests, more money in the pockets of the families in this region, then wonderful. We're looking forward to it. And I think that's what's probably the most exciting thing. And I just want to put one plug in for this region, specifically for those of you who are sitting on this call and thinking about kind of, what North America has to hold. And I think there's a lot of encouraging developments in Washington towards land conservation. I think 2 years ago, the permanent authorization of the Great American Outdoors Act was made, which channels over $900 million of funds towards conservation in the United States. And that right there is a reason to invest. But I think that, specifically in our region, Appalachia, we're seeing probably some of the highest levels of biodiversity. It really is a confluence of many different factors. So high biodiversity, high biomass, very high biomass in this region, and the fair market value of lands is low compared to the rest of the United States. So I think that those three things really kind of, make an argument for investment in this region, but I think all across the United States, there's great opportunities for investment. So I'll just leave it at that. Thank you.
Oh, that's perfect. Amrita, what's on your mind?
I'll be quick. I'll just say that I think the developments in forward contracting and different program standards around like Verra and Car in terms of forward mitigation units is really interesting because I think that will open up a whole bunch of opportunity around reforestation and restoration post wildfire.
Perfect. Blake, what do you think?
Yeah, I'm excited about two things, kind of the continued opportunity and maybe recognition of natural forests and really sustainable forestry in general to provide some scale in the climate solutions kind of discussion. That's exciting. And then also something that Curan mentioned, and it's been talked about a lot, but is a growing recognition of these co-benefits beyond just carbon, but the biodiversity, the watershed health, and all the other things that we know a healthy and vigorous forest provides. So those are really exciting things from my perspective.
And I know that Verra has been doing exciting things as well in biodiversity, not just carbon, but other markets as well. David, do you want to comment on what you find exciting?
Yeah, I mean, I think I would just echo a little bit what Curan was saying about bringing in smallholders. We're working closely with TNC and the Family Forest Carbon program to try to do that, right, and crack the nut on how do you bring in some of the smaller scale potential beneficiaries of carbon markets. And we're starting to see that in agriculture. So I think people, with the advent of new technologies like remote sensing, satellite imagery, and even artificial intelligence, you're starting to see the opportunity of how you can actually bring that to bear to reduce the transaction costs and get more people involved. So that's very exciting. I mean, I also just, reference a little bit about what Amrita said about the early financing for projects. We put out a consultation late last year, what we call the Early Finance Carbon Unit. Probably will change the name, but really the idea there is to enable a registry listed unit that people can invest in that will turn into a carbon credit and allow that transparency that the market needs to be able to have confidence that they can invest in. So there's a couple of very interesting things. And just the last to pick up on what you said, one of the key things that carbon has, it's really nice, is that you can label your carbon credits with other certifications. So we have two certifications that you can use. One is the Climate Community and Biodiversity Standards. The other is the Sustainable Development Verified Impact Standard. So you can essentially label or staple your carbon credit with all these other benefits that you can bring to the table. And if you think about what you can do with agriculture or forestry or wetlands, some of those other benefits can be really important, whether it's water conservation, et cetera. So those are really good points to leverage that can really help to tell a bigger, broader story about what your investment is generating.
Well, great. Well, I think we're at the hour, and maybe as moderator, I can just have a brief last word and to say that I hope that this panel has helped people understand that forestry and now, with agriculture emerging as a natural climate solution is a sector that is investable. The ecosystem service markets are complementary. There's incredible rigor behind that. There is both philanthropic and public funding to help support that. The wind is at our back is I think one of the key messages here. If you have not adopted natural climate solutions as part of your investment portfolio to address climate change, it is an absolutely necessary component. I think as we've seen in various presentations and reports, it's 37% of the solution in the next 10 years. And I would invite you, I think in the program, you have the ability to contact any of the speakers in this panel. And I would invite you to follow up with any questions you might have and to jump in if you haven't already in natural climate solution investing, because it is the future. All right, thank you, everybody. That's a wrap.
Thanks, everyone.
Thanks, bye-bye.